to the virtual CPE seminar on key review points in GST, Annual Return and Reconciliation Statement Financial Year 2021. This program is being hosted by Ernakulam branch of SARC of ICAI. May I request our Vice Chairman of Ernakulam branch, CA Jose KV, to kindly welcome our speaker, CA Ganesh Prabhu, and the guests for the day. Over to you, Vice Chairman.
Thank you, Deepa, our Secretary of Ernakulam branch. Very respected speaker for this afternoon, CA Ganesh Prabhu from Chennai. My managing committee colleagues, Secretary Deepa Varghese, past chairman, CA Srinivasan, Sikasa chairman, CA Salim, all senior members and friends. A warm good afternoon to all of you. To us, the time that if you look at the last date for income tax, last date for GST, even company filing all extended, and we are under great relief for some time from 15th of this month. And even though GST it's not mandatory, the audit is not mandatory, but I think we as a professional, as a chartered accountant, we only doing all the annual return, as well as before filing annual return, we are trying to reconcile the annual return with the books of accounts. So I think we are busy with that, even though officially the annual the auditor or filing of reconciliation statement by chartered accountant for the year is even abandoned. But still, I'm sure all the professionals, all the chartered accountants are doing that. And of course, there are a lot of important points. We have to be very careful on filing annual return and reconciliation of statement. So here today we have Ganesh Prabhu, always our friend. We can say the great good friend of our branch. And as I told Ganesh sir, he is coming with a new face now for at least for last 2-3 years. We can see a different face of our Ganesh Prabhu sir. Of course, the GST, the discussion on today also, there are a lot of new things we could hear from him. I wholeheartedly welcome on behalf of FC Ernakulam branch as well as all the participants here. I wholeheartedly welcome Ganesh Prabhu sir for this program. I also welcome all the colleagues, Deepa, Srinivasan, Salim, and all the senior members and friends in CA fraternity to this CPE seminar on key review points in GST. Over to Deepa. Thank you very much.
Thank you, Vice Chairman. Like our Vice Chairman said, CA Ganesh Prabhu sir is definitely a friend of Ernakulam branch. He needs no introduction. He's done so many programs for us, a person who's away just at a phone call. As you all know, he is a Chennai-based chartered accountant in practice, and he is also a systems auditor, a Bachelor of Law. He has done a certification course on indirect taxes from ICAI and has been he qualified as a chartered accountant in the year 2009. He's also done his master's in financial management from Pondicherry University, before which he did his Bachelor of Commerce from University of Madras in 2005. Presently, he's a partner in C. Ramaswamy and B. Srinivasan Chartered Accountants, Chennai, and he's a partner specializing in indirect taxes, representing clients before customs, excise, service tax, appellate tribunal, commissioners, and other adjudicating authorities of service tax, central excise, and customs, and is involved in internal audits, projects audit for capital expenditure. He's also a faculty member and has presented papers in indirect taxation on SARC of ICAI, various branches of SARC study circle, National Academy of Customs and Excise Narcotics, regional training institutes at AG's office, Chartered Accountants forums such as Chartered Accountants Study Circle, Chamber of Indirect Professional Taxation, etc. He's also a resource person in ICT Academy and a member of the ICAI GST group in Chennai, which contributed in development of background material of model GST law developed by the Indirect Tax Committee of our institute. He's a visiting faculty in Loyola Institute of Business Administration, our mother ICAI, and Institute of Cost Accountants of India, Institute of Company Secretaries of India, and has handled professional classes for students in subject of indirect taxation. He's handling classes for CA, CS as well as CMA in various places, and is a secretary of the International Chamber of Indirect Tax Professionals, an association dedicated exclusively on indirect taxes. With these words, sir, may I welcome you to kindly commence your deliberation on the key review points in GST, annual return and reconciliation statement, financial year 2021. Over to you, Ganesh, sir.
Thank you. A very warm welcome to all the dignitaries who are all virtually present. Chairman of Ernakulam branch in absentia, Vice Chairman Josh sir, Secretary Deepa ma'am, followed by past Chairman Srinivasan sir and Sikasa Chairman Salim sir. As Vice Chairman has very rightly pointed out, often there were many circumstances I could have the opportunity and privilege to be part of various initiatives of in GST of Ernakulam branch. It's always a pleasurable moment to be with. This time on a very different note, no doubt, very rightly pointed out by our Vice Chairman that though the Section 35 GST audit by the Chartered Accountant, which used to be mandatory activity, was being as part of ease of doing business, reason best known to the government, is being taken away. But no doubt, even today, as part of various other activities, it is very difficult for a businessman, even if he have a good number of chartered accountant or somebody who is good in tax practice, to take care of this particular annual return and the self-certified reconciliation statement on their own is going to be, no doubt, is not an easy task for any organization for the first year to take it on their own. Having said all this, getting into straight into the specific annual return, are there any changes that they have brought in into this GSTR 9 and so-called the 9C, the self-certified reconciliation statement? As the name stands simple, there are no much changes, but for the signing of the reconciliation statement by the chartered accountant, which used to be mandatory, that was alone done away with it. But for it, no great changes. Having said that there are no changes, this has brought in a few areas where today, as a chartered accountant, we may not be filing the return for and on behalf of the respective assessee, but there are many opportunities that maybe we will be reviewing those returns, or we would, before filing a single check, would have been done by us. Given an environment like this, can we make a little value addition to our review? Or in other words, what are the areas that are little important from the perspective of this filing are going to be our discussion for the day. Having said that, I thought it would be proper for us to get into the respective tables that are going to discuss about these returns. I tried my best to bring out the same feel-good feeling of seeing on the virtual screen when we used to see those numbers when the data activity or data been updated what it used to be. Coming back here to start with, usually the due date used to be 31st December on account of COVID plus various other reasons that are associated with it by default of extending the due date of income tax. The GST R9 and GST R9C due date is also extended to 28th of February 2022. An important point to be noted down over here is the moment they reduced or deleted or rephrased the section 35 subsection 5, where they removed the certification by a chartered accountant is not mandatory, where it can be a self-certification. Today, along with that form GSTR 9, form GSTR 9C, a self-certified reconciliation statement has to be filed. Very interesting to note. Earlier, late fee used to be per day delay late fee used to be applicable only to form GSTR 9. Now, both form GSTR 9 and GSTR 9C, which are as part of section 44, are going to be covered by a same provision for account of late fee. The late fee is going to be doubled in case of this. For GSTR 9, there is going to be a separate late fee. GSTR 9C, there is going to be a separate late fee. So filing within the due date is going to be of paramount important in connection with all these assessments. Getting into the basic components of form GSTR 9. We are all aware of this structure. It's a 6-part structure where basic information, outward supply, a detailed information about input tax credit, followed up by taxes paid under reverse charge. Taxes paid information, previous year transactions reported in subsequent financial year or that year transaction reported in subsequent financial year, followed by all those refund, demand, HSN wise information, so on and so forth, are in-housed in annual return GSTR 9. Let me share some of the experiences of filing of some of these annual return. Honestly, if you ask me, is filing of annual return is such a paramount important activity? The answer is a very simple yes. I'm sure a lot of our members would agree with me. Not only the Kerala GST department, be it CGST or SGST department, has started conducting GST departmental audit under section 65, where when they used to go and do and conduct that departmental audit, they are very clear, they are very, very clear that they want to rely upon some of these annual return filed. Even if there is a possibility of any errors of omission, errors of commission, or whatever be it, that are incurred at a monthly return level, but it all gets rectified at the annual return. If this has been the fact, they are ready and prepared to accept the annual return as the final document for that financial year. So coming back here, having said the importance of annual return is very high, any errors which are done during filing of monthly return, and it is quite easily possible given the due dates, given the pandemic, given for the first time we had the country, many employers get into this model of work from home for their first time. There are possibilities. If someone did error-free filing of return, I'm happy for them. But point that I want to drive home is there were instances in our own offices where one of the annexure was not uploaded properly because of the bandwidth related challenges at the filing end of the intern level, followed by there were circumstances where they data keyed in certain information, but it was not uploaded. There used to be some kind of errors at a monthly level. Can we rectify all this at the time of filing the annual return? No doubt. The answer is a very simple yes, it can be done. Before filing of annual return by a normal taxpayer in form GSTR 9, two things should have been completed. One, his registration should be up, running, and active. Two, they should have filed their form GSTR 1 and GSTR 3B for the financial year April 20 to March 21. I'm sure nobody would have till now would have kept open their filing of return except for certain specified or recommended purposes for them. But usually they should have filed. In case if any of those one or two returns are not filed, then the dashboard in connection with annual return will not open. Having said that, getting into after the basic information is going to be auto-populated, GST and trade name, the financial year and the due date, all these informations are going to be auto-populated. But for one question that will be asked, do you want to file a nil GSTR 9? If the answer is yes, then it will be filed. Naturally, if we have some numbers to do a data entry, we would be taking an option no. Many times, this report, which is below the basic information detail, is not used as effectively as it has to be used, is my apprehension. Many times I come across, because this is one sort of report available, very popularly called as system computed summary. The 1 year summary of GSTR1, the whole year summary for GSTR 3B, and based on the GSTR1 data filing and based on the GSTR 3B data filing, system itself prepares a tentative system computed summary of GSTR 9, and the same is available for a download. Why this has to be used? Let me repeat, it would be a guiding factor for us as part of our review. As simple as that. The GSTR1 discloses a turnover in B2B, B2C. If I sum it up, together it sums up to a turnover of 10 crore 32 lakhs. To the contrary, when I download my GSTR 3B, it shows a turnover of 10 crore 25 lakhs. At a face level, on a just review, on just download of two important consolidated documents, on a review, we would be able to decide that there is some differences and it has to be reconciled. Let me repeat, I'm not even concluding the assessee has to pay. There are some differences between 1 and 3B. It has to be reconciled. Maybe that. GSTR 9. When we download the system computed summary GSTR 9, we would be able to know whether what is this assessee has done during the said financial year. In the financial year 2021, is he engaged in taxable supply? Is he engaged in exempted supply? Has he availed his credit properly? Has he reversed his credit wherever required? Is he engaged in zero rated supply? Is he engaged in SEZ supply? Is he engaged in EOU supply? All this can be at a glance of this form GSTR 9. At one go, we could be able to assess it. It would be a very important guiding tool in connection with the reporting, no doubt about it. Be a guiding tool, no second thought about it. The tables would be lined up in this model, which we are very conversant about this model of reporting. So straight away, I'm getting into part 2, the very important table, table 4. Part 2 has 2 tables. Table 4 would discuss about all those outward supplies on which tax is payable by the registered person during the financial year. Outward supplies on which tax is payable. Is it only outward supply on which tax is payable is going to be reported? Very interesting to note. Even RCM will get reported in table number 4 only. So, table number 4 of GSTR 9 not only discloses about outward supply on which tax is payable, it also discloses about inward supplies on which tax payable under RCM. So RCM liability plus outward supply liability both are covered in table number 4. Often I would highlight there are only 5 areas that need to be concentrated in filing GSTR 9 part 2, precisely outward supply. In outward supply, what are the B2B supplies? What are the B2C supplies? Business to business, business to consumer, zero rated supply with the payment of tax, SEZ supply with payment of tax, and deemed exports. Broadly, the supply of the taxable supply, at least the taxable supply of the organization, is characterized only to this 5 elements. So when we see a turnover of 10 crore rupees, 5 crore rupees, 6 crore rupees, our mind at that level will process, is it B2B or B2C? Having said it is all taxable supply. Okay. Having said all taxable supply, is it B2B or is it B2C? Followed by, no, so much turnover is B2B. Yes, that will be reported in B2B. Now, is it entirely B2B? Does it contain zero rated supply? Where zero rated supply with the payment of tax to foreign country, is it possible? Yes, that will be reported separately. Zero rated supply to SEZ, is it possible? Yes. These information are already feeded at the time of filing periodical return in the respective GSTR 1. From the book, we can able to extract what are the supply with the payment of tax done to SEZ. From the book, we can extract what are the supplies that are exported to foreign country with the payment of tax. From the book, we can extract what are the B2B supplies. So we can verify that whether all this reporting is done rightly. Followed by the respective tax associated with it. That should also be reported correctly. So here reporting is a little more important because zero rated supply with payment of tax to foreign countries, zero rated supply to SEZs, deemed exports. all are to be reported separately because they form part of different table in GSTR 1 itself. So it has to be reported separately. If an assessee is engaging in that, yes, it has to be reported separately. Moving forward from the broader 5 different types of supply. Advances. There are possibilities, preferably the service sector, in case if they have a practice of receiving advance and paying taxes on the advances received, then they should have a strong reconciliation for receipt of advance, reporting of advance, adjustment of advance, and the balance unadjusted advances at the end of the year. Let me repeat, I'm very careful in my wording. The balance unadjusted advance at the end of the year, advances on which tax has been paid but invoices has not been issued during the period. So during that period, what are all the unadjusted advances that should form part of ORF? Many times this would not be applicable to majority of the assessors. But a point to be noted down, if they are construction company, if they are works contractors, if they are repair and maintenance contractor, EPC company, or it is going to be some sort of wherever any kind of EPC, they are involved, solar power plant, solar power generation system suppliers, many of them are there. These organizations have a very high potential of reporting their table 4F prompt. It's very important for them to report because that is the amount of advances on which tax has been paid but invoices has not been issued. If let's say during the year they have received 5 lakh rupees advance, then on receipt of 5 lakhs they will pay GST. Out of this 5 lakhs, only 3 lakhs that they could adjust with an invoice which they have raised subsequently. That 3 lakhs adjustments will be reported in GSTR1. Now, at the end of the year, it is becoming our duty to report 2 lakhs. In other words, in the balance sheet, below the liabilities, more precisely on current liabilities, under the heading other current liabilities, below other current liabilities, advance from customer, there one number will be reported by the company. That number should be reconciled with a single GST, and in case of single GST, that number should be reconciled with 4F through a separate reconciliation statement. In case of multiple GSTN, if we add all the respective GSTNs 4F which talked about the advances on which tax to be paid, once that is being done, once when we add all the multi GST and 4F, it should match with the balance sheet. Let me repeat, advances has to be reported more meticulously, precisely advances for which invoice is not issued in the earlier invoices. Moving forward, in case of same outward supply, table 4, one more information need to be filled is inward supply on which tax payable under reverse charge. inward supply on which tax payable under reverse charge. Something very interesting to note over here is any RCM liability will get disclosed under this enter. I'm sure all of us will remember 4G because that is one of the important technology revolution that has happened. No doubt 2G, 3G has created its standards, but nothing like 4G. 4G has set the tone in connection with its bandwidth, data connectivity, movement of data, many things. Coming back here, say table 4G discuss about inward supplies on which tax payable under reverse charge. Inward supplies on which tax payable under reverse charge will be reported in table 4G. There could be a possibility or organization who is dealing with buying and selling of goods. They are engaged in a activity which makes them liable to pay tax under RCM. It could be a transportation of certain goods which triggered RCM. It could be a payment of an advocate fee or import of service, or they have imported goods. That import of goods result in a ocean freight. On the ocean freight, they are liable to pay tax. Or it is an import of service, or it is going to be various other RCM on goods or RCM on services that are notified by the government. Among the RCMs, let me repeat, today during various audits, investigation, search and seizure, we come across officer pointing out that on this transaction you have missed to pay tax under RCM. On this transaction, supplier is liable to pay tax under RCM. They have not discharged their tax liability under RCM. No doubt, whatever tax that is paid under RCM, if they are used for the furtherance of business and it is going to be a taxable supply, they are entitled to claim credit. No doubt, at a later date, someone can very well establish a fact the matter is revenue neutral in nature. But today, at least we would have defended till now more than 30-40 notices on the count that it is revenue neutral in nature. Everyone started points out reverse charges. When we glance through the expenditure of the organization, maybe those thoughts can be part of our mind. Even now, if in case they have already paid some RCM, it is not too late. It is not too late. Even now, it can be identified, paid along with interest, and credit can be claimed, subject to a dispute associated with whether the said credit is eligible to be claimed. No, I'll take the principles of doctrine of mutuality and principles of doctrine of revenue neutrality, and we would stay by that principles of doctrines of revenue neutrality. Then there is a high possibility comes out and steps that they may be involved in that matter. So my intention only here as part of 4G is, if there are going to be any reverse charges liable for the company, let us point out to the respective management. It is the individual management call. At the departmental proceedings level, we are finding it extremely difficult to convince the other party that you can very well apply the principles or doctrine of revenue neutrality. Many times officers comes out and ask us, is it not you are liable to pay tax when there is a levy? That levy has to be fulfilled. I am not questioning your eligibility to claim credit. I would very well say your eligibility to claim credit is lost because of section 16(4). The time limitation is now not applicable. Let me repeat. A very big question still going on, whether somebody can claim credit even beyond limitation in case of inward supplies on which tax payable. Be it RCM, be it advances, be it various other forms of taxable outward supplies. Those are the first front runners of capturing information. Having said this, there is a very high possibility of debit note, credit note being issued by a supplier. To increase the value of supply, a debit note will be issued by a supplier, generally rare. To reduce the value of supply, to reduce the tax payable, a credit note will be issued by a supplier, goods returned credit note. Discount given, additional discount given to the supplier, credit note, because we have to reduce the value. Wrong value I have charged and it has to be reduced, credit note. Wrong rate of tax I charged, credit note. This credit note issued by the supplier is a common feature with almost majority of the GST returns. But a very important point need to be noted down here is, let's take a very simple mathematic. 1 lakh rupees is value of B2B supplies. 10,000 rupees is the value of credit note issued by the supplier on account of sales return. On the outward supply, I can report as B2B 1 lakh and report the credit note separately 10,000. One way of reporting. Another way of reporting, outside the book, adjust that number 1 lakh minus 10,000 and report only the net number in B2B supply as 90,000. No doubt, the press release by the government in connection with Form GSTR 9 and 9C, not now, initially itself, has acknowledged the fact it is optional. Let me repeat, it is optional to fill net of credit note, debit note, and amendments for transactions made during 4B to 4F. For all those transactions of taxable supply and the supplies on which they received advances. For all these supply, if you want, you report the gross number in the first part of the table and the adjustments or amendments in the second part of the table. Alternatively, report the net number in first part of the table. So I have two methods of reporting which is open. I can report it as 90,000 net or 1 lakh minus 10,000, 90,000. No hard and fast rule. There are assessees who report 1 lakh in B2B in table 4B. Here they will report it as 1 lakh. And credit notes, they will adjust it 10,000 rupees and the final net number will be 90,000. Option 1 method of reporting, very valid, very elaborate reporting, and this will give us a clue that there are credit notes. Even otherwise, if we download the GSTR 9 system computed summary, we will know there is credit notes. Now, alternatively, why to report 1 lakh and 10,000? We will report a net number 90,000 here in B2B. Both way presentation allowed, but a key takeaway for us, one of the key point here is, in case of credit note, as a review modality, we should ensure these credit notes are issued for a valid reason. Let me repeat. I have come across instances where the credit note issued itself is not valid. Somehow the assessee failed to understand. No, see, today I no need to link with. Today you no need to link. But those credit notes at any point in time will be reviewed by a GST officer because of a simple reason. We are reducing his money. We are adjusting with our current tax liability. Definitely an officer will ensure whether the credit note is issued for a valid reason listed out under section 34. What are the valid reasons for which credit note can be issued? As I earlier mentioned, changes in rate of tax, changes in value, change in or deficiency in supply of goods or services, or it is going to be a change in the value itself. Sorry, value, rate of tax, cancellation or deficiency in supply of goods or services, not cancellation, deficiency in supply of goods or services, or sale return of the goods. Only for this 4, plus when we read through section 15 subsection 2, sorry, 15 subsection 3, we will know for discounts credit note can be issued. 5 reasons. But for this 5 reason, the 6th reason itself is not possible. Only for this 5 reasons credit note can be issued. In case if they adjust, if somebody is adjusting 8 lakh rupee credit note, 10 lakh rupee credit note, 2 things we will expect. Is this credit note is for what purpose? The validity and reporting of credit note. Does the credit note is reported well within the time? Do we have time limit for reporting the credit note? Yes, same section 34 comes out and highlights the time limit for reporting a credit note is before filing subsequent financial year September return. Now that due date is only for ITC, no, not only for ITC. Any amendments, any reporting of credit note and ITC, the due date remains same. Subsequent financial year, September return filing due date. The September month return filing due date of subsequent financial year is going to be the due date for these corrections. So if and only if a correction for a credit, if and only if the correction is done within the time prescribed, that only will trigger as a reversal of ITC to the other person. Understand? It does not stop here. A credit note issued by a supplier triggers as a reversal of ITC to the recipient. Many recipients don't give weightage to the credit notes itself. They are all suffering in audits. They are all suffering in audits. See, unfortunately, the department sits with the beautiful data which they never had all along. They never had such a access. On a click of a button, they get what are all the credit notes that the assessee has received from various suppliers. Forget this fellow raised. He would have bought goods and he would have returned. But the return will be done by the purchase department. They would have not informed to the accounts department. Accounts department would have claimed the credit, or the taking of credit is outsourced to somebody else. X, Y, Z reason. I am not getting into that X, Y, Z reason. End of the day, the credit that is availed by the respective person is reversed by the supplier. When we go and meticulously check, we have come across instances where the respective supplier of goods supplied to the person. The other, because the person who has taken credit has returned the goods, the other party raised a credit note, which is very fair. Whereas this person has not recorded the said facts in his books of account, one, which is a mistake. Two, he has also not reversed ITC. And at the audit level, if this point is raised, it reaches to 7 lakh rupees. Let me repeat, that's a huge sum. 7 lakhs of ITC reversed for the financial year 18-19 and identified sometime during January 21 is huge. Credit note reasons become mandatory. Rarely an organization will have debit notes. Rarely organization will have debit notes, and those debit notes, whatever organization has a debit note, those debit notes, they would have paid the taxes promptly. I am not stepping into that area, but my request is only, are they liable to pay interest alone need to be verified from a debit note perspective, because the time of supply for the debit note is the original date of invoice. Time of supply for the debit note is the time of supply for the original invoice. What is the time of supply for the original invoice? Same is the time of supply for a supplementary invoice or a debit note. Though it can be raised today, the debit note interest would be applicable from the date of original issue of invoice. Those small aspects to be taken care of. Any amendments, be it increase in value or decrease in value on account of any errors, generally that can be adjusted and a proper number can be reported in B2B, B2C, zero rated supply with payment of tax, SEZ and deemed export. In case if they want to be little clear, they may report those amendments done through the return in the field separate. Finally, a net taxable supply will be arrived. A net taxable supply will be arrived, and this number will be compared with GSTR 9C. Let me repeat. When it comes to outward supplies, you would be having 5 modes of reporting of outward supply, including the credit note, debit note adjustment, including the increase or decrease amendments. 5 areas to report. One more area for advances. One more area for reporting of reverse charge mechanism. So that would take us to the key areas in table 4 of GSTR 9. Honestly, if you ask me, there are only 4 important tables in GSTR 9. Often I would share, okay, maximum 5 tables. Okay. Honestly, 4, okay, you can add one more table 5. Why? Because rest all other information are all other information, not important. Among that 5 tables, this is one of the tables. Table 4, table 5, table 6, table 7, and part 5 tables, table 10, 11, 12, 13, which is 5th table. Honestly, just 5 tables to take control. To take control, complete grip will be available. Coming back here. Part 2. Same part 2, table 5. Outward supplies made during the financial year on which tax is not paid. There would be possibilities that we would be dealing with an organization who is engaged in zero rated supply without payment of tax, ACZ supply without payment of tax, followed by exempted supplies or non-taxable. By and large, predominantly we will be having this 4 variants only as assessee why he is not liable to pay tax. Zero rated supply without payment of tax. It is as simple as that a company is exporting services to foreign country. After obtaining a document called as LUT and signing a bond digitally, the respective organization has the facility to export the goods, export these services to foreign country and to ACZ without payment of tax. Here also a point to be noted. Export without payment of tax is also possible. Export with the payment of tax was also possible for the financial year 2021. I am aware of certain clients where when it comes to goods, they will export with the payment of tax. When it comes to services, they will export the services without payment of tax. So organization did multi varieties. Can both is possible? To my mind, yes, both is possible. Can both be allowed in an organization? Definitely yes, there were no restrictions, but of course, whatever I am highlighting here are not much relevant on or after 1/1/2021, as the model is very precise that it is going to be only without payment of tax. So coming back here, apart from exports, apart from SEZ supplies, exempted turnover. The whole turnover of the organization will be exempted from levy of GST. Or they might be engaging in certain supplies which are not liable to tax. They may be engaging in supply of alcoholic liquor. It might be a restaurant. Then alcoholic liquor is a non-GST supply. It would form part of non-GST supply. Petroleum product is a non-GST supply. Maybe organizations would have dealt with high C sales, no supply transaction, schedule 3 transaction. So properly it has to be reported, and I would recommend as a key point here is, if an organization claimed in table 5, this is zero rated supply without payment of tax. This is exempted. This is non-taxable supply. If they claim a number, if the organization say a number, it becomes as part of our review responsibility to authenticate whether such compliance as required has been complied. For example, there was an organization who has exported services, not very great number, 30 to 33 lakhs. They have exported services. Very interesting to note, they have also received the currencies from foreign country. Unfortunately, they were not aware of the process called as export, LUT. And I'm talking for a financial year 2021. The whole transaction come to light only during 21-22 when they come up for filing of the income tax return. They are GST holders, they are periodically filing their GST return and everything is filed as nil return. No reference of the export at all is made there. They did their services, received their money, that's all, matter in there. My intention here, just to highlight is, if they claim the export benefits for foreign country, let us ensure, do they have a valid LUT? Followed by, in case if it is a SEZ supply without payment of tax is reported, SEZ supply without payment of tax is reported. Very recently, we have an amendment which we were highlighting for quite some time earlier also. Ensure whether the said supply made by the assessee is used for a authorized operation. Whether the said supply by the assessee is used for a authorized operation. Points here for our discussion are: there was a supplier who used to supply certain premix powders, edible powders, premix powder, which will be consumed or which will be used in a coffee vending machine. And when work from home was not that aggressive, when work from home was not that much aggressive, he used to, one minute, just give me a minute. When work from home was not that much aggressive, he used to supply those coffee vending powders, premix powders, to ICAI unit. Quite some time we were highlighting to them, saying that you will not be entitled for this exemption. This is a consumable item by the SEZ. SEZ has to pay GST to you. You have to discharge to government. If in case ITC is entitled, ask the SEZ to claim the refund. You don't get involved in it. All that we have been highlighting to him. To our surprise, he never accepted our view at all. But point here to be noted is, we have a very recent amendment on 16.3 in connection with this. Two, we had enough rulings plus various other decisions that the so-called SEZ supply without payment of tax should be used only for authorized operation. So as long as if they deal with SEZ, then yes, this should be highlighted. Any exemptions, if it been enjoyed by the respective assessee, then the said exemption and its validity has to be verified. A few cases maybe there would be a different thought process. The respective assessee would be of a view that it is exempted. Maybe while review, we will be of a view it is not. Some sort of documentation in case of point of differences can be recorded and kept, so that tomorrow it would be little more better for us. Coming back here, any credit notes, any debit notes, any increase or decrease in amendments can also be reflected either separately where they will report the gross and then here, or it can also be conjoined together and get reported. Our intention here is even a exempted turnover not reported, even a no supply is not reported, even a non-taxable supply was not reported. All this has to be reported by the organization now so that it reconciles with the reconciliation statement. Very methodologically, the total turnover is arrived, where if we go back and meticulously read through that, the turnover from table number 4 is summed up, plus the exempted turnover is totaled, and they exclude the turnover under RCA. In fact, what is appearing in 5N? What is appearing in 5N? Many times in smaller organizations, it should match with the turnover that is there in the profit and loss. If it is a small organization, I don't expect a multi-state GST organization, it should match. But given a single GST and operated as a C, this should by and large match. I don't find any reasons why it should not match. Normally it should match. That is what is the reason that I at least foresee from a disclosure perspective. That would sum up a complete discussion on table number 4 and table number 5 of outward supply. Quick questions can come to our mind. If every information is reported correctly in the return, we don't have much of difficulties. If it is a taxable supply, we will move it on to table 4. If it is an exempted supply correctly reported, we will move it on to table 5. In case if a transaction of financial year 2021 for some reasons got reported in subsequent financial year in form GSTR 1 and 3B. Now, what would happen to that reporting? In other words, August 2020 transaction, 14th August 2020 transaction got reported in August 21 return as 14th August 2020 transaction. Will it be part of my table 4 as it is a taxable supply? Will it be part of my table 4? Or in case it is going to be an exempted supply, will it be part of my table 5? Answer is no. More precisely, I am now dealing with taxable supplies, because exempted supply, I come from a school of thought, table 5 is the conclusion for exempted supply. Table 5, reported, not reported, reported in subsequent period, all will come. But that is not the situation when it comes to the unreported transactions in that filing year. In case August 2020 transaction got reported in subsequent August 2021, then it would form part of table 10. In other words, later we will discuss after input tax credit part 5, transactions of current financial year. Current financial year is 2021. Reported in SFY, subsequent financial year up to 2020. All those transactions of current financial year reported in subsequent financial year, these transactions, no doubt would be reported in table number 10 if it is going to be increase in the value of supply. If it is going to be decrease in the value of supply, like a credit note. A credit note of October 2020 reported in May 21 would form part of table number 11. It will not come to table 4 and 5. Transactions of current period reported in subsequent period will not form part of table 4. It will be part of table 10 and 11 of part 5. Somewhere this fundamental aspect has to be kept in. Then only the overall reconciliation would go, followed by. There would be an exceptional circumstance where a turnover is neither reported in current financial year nor reported in subsequent financial year. Will there be possibilities? Yes, preferably this will be a B2C transaction. I don't find a B2B transaction missing out 18 months because at least from October 2020, people started to cross verifying to a reasonable extent. Transactions started to be reported. But there could be circumstances in organization where they are dealing with B2C transactions, very common, neither reported in current financial year nor reported in subsequent financial year. If that be the situation, if a transaction neither reported in current financial year nor reported in subsequent financial year, then law simply highlights it should be reported as part of table 4 and 5. So in case if it is reported subsequently, then it will go to table 10 and 11. If it is not reported, it should be form part of table 4 and 5, which is basically if it is exempted supply, then naturally exempted supply table 5 to go. If it is a taxable supply, it will go to table 4. All those transactions which are reported in GSTR 1 and 3B are alone the basis for preparation of this table 4 and 5. And often we will base the GSTR 1 for the purposes of reporting. My key points over here are only few. Modality of reporting is little important because it would help us in presenting the case in a better way, at least at a later point in time. Today, organizations would have made mistake, no doubt about it, in their reporting. But at least at their annual return, it can be cured and fixed more particularly. If it is reported within the financial year time limits, that is April to March of that financial return, then table 4 is the reporting area. For exempted supplies, table 5. In case if it is a taxable transaction, taxable supply, and reported in subsequent financial year within the given time, let me repeat, I am also very clear, within the given time, then it would be form part of table 10 and table 11 based on whether it is going to be addition of invoices or a reduction in amendment or a credit note. If it is not at all reported, it will be reported now in table 4 and 5. That would be the modus of preparation, and these aspects, whatever I have highlighted as part of table 4 and table 5, should be verified as a review points at every level when the data is there, these aspects to be verified. Getting into input tax credit. as part of input tax credit is concerned, no much challenges that are there, but for the regular challenges which we are used for it. When we come to the claims in connection with input tax credit, table 6 and table 7 are the prime table. Table 6 makes things very clearly that ITC availed during the financial year. ITC availed during the financial year. A breakup for this is going to be given. Let me repeat. ITC availed during the financial year. Breakup for this is going to be given. As we all know and we all have experienced, table 6A would be a auto drafted table. I am sure all of us who are all virtually seeing the presentation would see this place a little gray and this place is little bright. The difference is this number is an auto drafted number. It comes automatically. That number is an auto drafted number. Whereas when it comes to the table below this, the intention of table 6 is to just report what are the bases of the input tax credit. As an organization, the organization has availed ITC of so much. This organization, who has taken closely to 50 lakh rupees of ITC out of inward supply of B2B, how much ITC you have taken? Out of RCM, how much ITC you have taken? That too RCM from registered person, how much? RCM from unregistered person. Let me repeat, getting that data and all is little difficult. But we can get the data. It's not that it is not possible. We can get the data, but it's just, we have to be little careful here. B2B inward supply, that information will be with the organization. We can feed it. Whatever inward supply that comes to the organization, that would be that number. Similarly, in case of RCM, organizations are required to maintain the inward supply from registered person and unregistered person. If they able to share the information, then yes, that would be the basis. Failing which, if they don't have that information, then the law is very clear that all the ITC would be mentioned in inward supply from registered person. If they have how much from unregistered person, how much from registered person, they can mention in unregistered person. How much registered person, how much. Otherwise, every data would form part of the registered person. B2B supplies ITC, input how much, input services how much, capital goods how much. If they have the breakup, they should be mentioned. And otherwise, it would straight away, the data in connection with input will be filled. RCM related credit, how much from registered person, how much from unregistered person, credit taken, that would be the basis. If the data is not available for some reason, if that said data is not available, whatever credit they have claimed on RCM would form part of registered person information. Credits on account of import of goods, credit on account of import of services will be reported separately. Credit from ISD, rarely used, but credit from ISD would be reported. When all this is done, Here we would have a difference, more precisely in table J. See, 90% of the company we will not have difference because they would have claimed credit genuinely, regularly, which will match. It is comparing, or it is only just giving breakup. Beyond that, nothing. What is your credit? How much is B2B credit? How much is inward supply RCM from unregistered person? How much is inward supply RCM from registered person? How much is the import of goods credit, import of services credit, ISD credit? Just that's all. This information, in any case, should be available with an organization and they should be in a position to share. And wherever possible, they want to do a segregation between input services and capital goods. Wherever required, they wanted that segregation. B2B inward supply, agreed. Want information further detailed. Input how much, input service how much, capital goods how much. I honestly don't understand the need behind that. But however, from a strategic analysis of given data, I could able to smell the need for refund, the need in connection with refund related reviews. For those information, it would be better. But very rarely organizations could be able to give that data also. Coming back here, if in case they find any differences, then that difference will be part of J. It is as simple as that. The organization has taken a credit of 12 lakh rupees of IGST. The organization now has to give breakup for 12 lakhs as to how much is respective credit. Failing which, that amount is payable. So, no doubt, if in case we come across any differences in the particular table J of table 6, then it is a hint to the reviewer that the organization has claimed excess ITC. As per books, the breakup is that's all, whereas what they have claimed is little in extra. A tran credit in today's circumstance is not possible, but exceptionally, there are a few assessees who have filed writ petitions before the high courts. For those people, government has allowed in exceptional cases through the respective verdict given by the state high courts, the respective states high court. You claim the said transaction credit in 3B. The courts are directed in 3 or 4 instances. Any assessee who, for him, which is going to be same covered matter, then he would also be with the same direction, file a petition before the court. Same direction would be given in that case also. My intention over here is in these circumstances, in circumstances like those situations, then they may be involved in a tran credit. Otherwise, nothing, no tran credit is possible. In case of any mergers and acquisition, or in case of certain special circumstances that occurs, like they have moved from composition levy to normal levy, or some of their goods became from exempted to taxable, there would be a possibility of additional claim of credit. These are all special circumstances, rarely applicable. If in case of a merger has happened, A Limited is merged with B Limited, then ITC 02 will be filed. So A Limited credit will go to B Limited with due verifications done in connection with it. So complete transfer of credit. Immediately it will happen. From here 38 lakhs to the next day morning, that money will go there and that money that company can enjoy because it's all through a process of amalgamation. So coming back here, in case of these circumstances alone, that yes, whatever money that are there, that will be used. Otherwise, table 6 is nothing but a breakup table. It just shares the breakup of the credit. What is the breakup for the credit? of the annual number. This in the table 6 is generally nothing but an annual number. Whatever that appears in 6A, it is an auto drafted number, no edits, nothing is possible, and respective assessee has to give a breakup for the same. Followed by, in case of reversals, table 7 discuss about the reversal. And why reversals are done. Why reversals are done. For a minute, there could be various reasons associated with it. One reason could be in connection with section 17.2 read along with rule 42 and 43, very popularly called as reversal of input services and capital goods for common credits, where in a business they are engaged in both taxable and exempted supply. Then the credit, common credit to the extent of exempted supply need to be reversed. Those reversals, or it is a wrong credit transferred by the ISD, so it need to be reversed, or it is an ineligible credit which need transferred by the ISD which need to be reversed, which in turn they have taken over there from credit from ISD, or the payment to the respective supplier is not made within 180 days as per the requirement of section 16. For that reason it is reversed, or it is an ineligible credit. They have taken the credit and they are reversing. As it is an ineligible credit under section 17.5, it will be reversed, or reversal on account of Tran 1, Tran 2, or excess of the data entry error for other reasons. Only one request of the government in table 7. If it is a transactional credit reversal, kindly mention the transactional credit reversal in the respective column. Respective row. Others you can put it in different way. If it is a tran credit reversal, it has to be mentioned only in row F if it is a tran 1 reversal. Row G if it is a tran 2 reversal. There are possibilities, maybe even when 6 months before also in one of the assessees cases, we had the opportunity to reverse because there's a different thought process. Not a very great amount, but again, the assessee was in a different thought process. Officer highlighted, no, this is not be eligible. Of course, the government has clarified at a later point, not at the original point. Maybe 5-6 months later, government took a position differently that it will be reversed. They are not eligible and it has to be reversed. The point here for our discussion are in those circumstances, in exactly those circumstances alone, respective reversals will be used. Otherwise, respective reversals will not be used. To the extent possible, we can try to fit it out in the respective section. If you personally ask me, if there is enough data availability there in the organization, then it has to be reported in the respective heading. Reporting it in the others column is not a recommended model. However, if organization says, I don't know the reason for reversal, maybe for 16, so 42, maybe for 43, I don't know. But again, in any case, this is going to be worked out very meticulously and then only it is going to be mentioned, then possible. Or it could also be otherwise situation where the earlier the product was taxable, now the product became exempted, or they have moved out from the composition levy. That is little rare, but earlier product taxable, now the product exempt would be a common point for reversals under the others category. But my intentions are To the extent possible, the respective heads can be used, and that has to be used to the purposes. And if in case we come across situations like this, maybe we have to be little careful here. One, on the ITC claim, whether he has reported correctly is important. At the ITC reversal end, the formula associated with it. That too, in case of Rule 42, 43 and all, if assessee has not reversed, we are seeing a lot of ramifications and challenges associated with it. It was a grocery shop where it has to be reversed. They have not reversed, creating certain challenges. There is a corporate office. That corporate office has substantial income other than interest income, which are all coming under the purview of common credits. As there is a good treasury operations, plus they are involved in investing the money which is surplusly available under various mutual funds and shares. Sale of mutual funds, sale of shares would also result in reversal under Rule 42, 43. No doubt, it is only the profit on sale of investment in case of a company, and buying and selling of shares in case of companies or any other person is going to get reported. But my intention here is, no doubt, those are all areas where it is considered, it is deemed as an exempted supply under Section 17. So if an organization has a income in connection with income or loss in connection with shares, mutual fund, all this to be looked into little carefully in connection with Rule 42 and 43 perspective. Followed by a net ITC would be determined at the end of the table after the consolidating the reversals, the total credit claimed during the financial year, total ITC reversed over here. This credit would result in the net ITC available for adjustments in the current financial year, which will also to be reconciled with an important table in 9C, which is table 12 and table 14. Table 12 and 14 would get again reconciled only with this particular ITC. This takes us to the next table in ITC, or in fact the last table of ITC, one of the very important, with due respects to our GST department officers. Many times they come across, somehow they are not comfortable. I don't know why. Very rarely I find a GST officer is little comfortable in seeing a negative number in 8D. Somehow every time officer wants only a positive number. To my mind, it is very difficult, very, very difficult. I have tried my best. Let me repeat, I have tried my best to the core possible. It's very difficult. And yet another challenge for us is table 8A, auto population. See, how this auto population happens till now is a mystery. Let me repeat. We all believe in a particular model. We think it is like that. And very few of us alone can able to drill down exactly to that number through other sources. Now coming back here, and there are exceptionally errors in the auto population. We have come across all this. One of the client ITC, if I go and download meticulously all the 2A, it comes up to 56 lakhs. I'm happy because the credit that is availed by the assessee is only 54 lakhs. But unfortunately, when I come and see the GSTR 9 table 8, it shows 28 lakhs. I still unable to reconcile how this difference is possible, because that's system based. The very purpose and the objective of table 8 is not to identify 2A versus 3B differences. It is meant for actually a different purpose. Somehow officer feel there should not be negative difference in table 8D more particular. That is, the ITC as per that financial year, it gets reflected. ITC reflected in 2A of that financial year get reflected. What is the B2B transactions that we have mentioned in table 6? Inward supply B2B, we have mentioned, no, that data is getting, that data comes and gets auto feeded here. ITC of this period claimed in subsequent financial year. That data would be feeded by the collector. Somehow in the table, I request, or I think one more row has to be added. That row is, at least we should add it in our working. That row is ITC of last year claimed in this year. Let me repeat. My table 6B data does not only in-house this year data, it also in-house last year data. Last year ITC, last year it reflected in my invoice, it reflected in my return. But I claim ITC only in this year because I have time till September, not every ITC, exceptionally 1 or 2. And if that is going to be substantial in nature, there would be a possibility of negative differences in table 8D. I can only maximum highlight to all of us. If in 8D, if there is a negative difference, it doesn't mean that a assessee has excess claimed ITC. No, not at all. Absolutely not possible. And somehow in annual return, my request is they should concentrate on table 5, they should concentrate on table 7, they should concentrate on 9C table 9, they should concentrate on 9C table 12 and 14 more meticulously. They leave all these tables, they catch hold of this table 8. Of course, we have the clarification from the department. Table 8 will not be the reason for issuing notices to set down that there is a difference between form GSTR 3B and 2B. But my only point here is, this is the easiest way for differences. This is the easiest way where all the differences are being pointed out or highlighted as the case. Why? Because the moment there is a difference, what happens to that ITC? ITC is available but not availed in case of positive differences. ITC is available but ineligible again. And in case of imported goods, what is the ITC as per imported goods and how much it is available? And how much credit of this is lapsed? A disclosure is required. Their thought process, I felt it is on to my personal note, their thought process is, a particular person has taken the ITC and or he has so much ITC, if he has not claimed in the subsequent period, then it will lapse to his account. Again, if we have a positive balance, it doesn't mean it's favorable. If there is a positive balance, there is a high probability that somebody would have availed this credit in the subsequent financial year. Maybe if this 2 rows are brought in, this table 8 would be of very great help. Of course, when we work for the assessees as a review matter, we can incorporate in our working table 8 differences. As long as it is minimal, it is better. The differences are huge, then we have to ensure other methods. There are there are instances in the past, I'm sure a lot of us would have had our own experiences in which the ITC is not matched and there are some differences. All this has to be precisely set out, and we would be having an option to do an attachment of what is the correct numbers that should be fed into A and what should be the ITC that you have claimed, what should be correct numbers. A reconciliation statement can be prepared for ITC and uploaded. There are instances where activity like that are already done by us. So table 8 is of little paramount importance when it comes to the real 2A 3B difference lies here. Okay. And if it is big, we have to analyze it little meticulously. Part 4 discuss about the tax payable. Whatever tax already paid in form GST or 3B would form part of the paid through cash and paid through ITC areas. Nothing can be touched. What only can be amended is only this tax payable area. This tax payable can be amended by us. If interest is not paid for delay in payment of taxes, maybe that can be highlighted. If there is a late fee payable for GST or one return belated filing, maybe that can be added. Followed up by during the period, if they have paid any penalties as part of various other activities, then yes, those penalty can be paid, referred here, so that the respective DRC 03 we can give a references. Those are all the amendments. Or now on account of additional tax liability, if they're going to pay some money, that can be amended here, added back here, and the numbers can be brought. As I earlier highlighted, whatever already paid through ITC, paid to cash, cannot be changed. Payable will be fed. The difference between payable and paid should be worked out, and that amount should be discharged through a separate form DRC 03, selecting the option annual return for a better understanding and purposes. Part 5. Any transactions of earlier financial year reported in subsequent financial. Any transactions of earlier financial year reported in subsequent financial year, then those transactions alone, those activity or those transactions alone would be part of this particular table. As far as this table is concerned, assessee has reported an invoice of a particular financial year, let's say 2021, not in the year 2021, but in the return of 21-22. As I earlier mentioned, it would be reported in table 10. An assessee reported a credit note of financial year 2021, not in the year return filed in the year 2021, but in the year up to September 22. Then it would be reported in table 11. Similarly, in the case of reversal of ITC or claim of ITC. ITC I am entitled to claim of 2021, but missed in the year 2021, but claimed in the year 21-22. Yes. Reversals of this particular financial year reversal, but I did it in subsequent financial year, will be reported. Table 12 and 13. Of course, no doubt these transactions are relating to CFY, current financial year, but reported in SFY, subsequent financial year. If those transactions are reported in subsequent financial year, then it will be having a separate disclosure. Part 5 is one of the important disclosure area because we are arriving the actual numbers. If we carefully note, last line is little more important. Turnover that we have determined as per table 5, outward supply turnover as per table 5, plus table 10, whatever omitted to be reported, now reported, whatever adjusted, done subsequent financial year, that is reduced. Reported this year turnover, but reported in subsequent financial year, added. This year adjustments done in subsequent financial year, reduced. Net number we will be arriving. My point, short point here to highlight is these numbers. These numbers are of paramount importance. These numbers, in case if the organization has reported its turnover subsequent financial year, it has to be reported in table 10 and 11. Then only it would be, otherwise it would result in as a difference. Let me repeat it. It would show as a difference. No second thought about it. Because when we reconcile from the total turnover, this turnover will come. Okay. So as per P&L, 10 lakhs. Whereas as per GST, only 8 lakhs. 8 lakhs. No, that's what I reported during the year. 2 lakhs I reported in subsequent financial year. Is it that a difference? No, not at all. 2 lakhs reported in subsequent financial year. If we feed the data here, automatically 10 lakhs it will come and appear. So 10 lakhs difference. One more, maybe I would share a secret ingredient I would also share. As long as GSTR 9C is filed with no differences, or differences as small as possible, the probability of it being scrutinized is less as compared to a GSTR 9C which is filed with huge differences, and which all huge differences are explainable differences. I'm not driving down that everything has to be reconciled. There are situations where it cannot be reconciled also, but to the extent possible, if it is reconciled, then it has added advantage associated with it. Any taxes that has been paid subsequently and the amount of tax paid is going to be captured in table 14. Followed by table 15, discuss about the quantum of refund claimed. Let us verify the purpose of the refund, because sometimes we come across the refunds are granted, but at times the claim made by the assessee or the respective consultant or the company, the claim are they genuine claim? I have come across instances where they have claimed even on capital goods, and it was also given where for an inverted duty structure, I'm sure all of us are aware, for capital goods or input services, ITC is not eligible, including but the only thing is before the attention in connection with inverted duty structure came, all these refunds were granted. Similarly, there are refunds granted prior to the changes in connection with HSN, or erroneously HSN was marked erroneously. That is where the credits in connection with the ITC breakup in connection with capital goods so much, input so much, input service so much will help us. Where when we see capital goods so much and this fellow claimed so much of refund, we can point out very precisely those were the aspects to be taken care. And let me also highlight, filling of table number 15 is not mandatory, it is optional. At the option of the assessee, the quantum of refund that they have, refund application, if any, they have filed, and the sanctioned and rejected amount are being given. Similarly, in case if they have sent some goods on job work basis and the goods are not returned within the time prescribed, or goods sent on sale on approval basis, if the goods are not returned within the time prescribed. In case of sale or return, it is 6 months from the date of the day in which it is sent for sale or approval basis. And in case of deemed supply under section 143, it is 1 year in case of raw material and 3 years in case of capital. So if the goods has not returned, then it would be treated as supply. Those information has to be given. It's very rare, applicable only for job work and those industry who send goods on sale or return basis. HSN-wise information. No doubt, optional field. Okay, be it HSN-wise outward supply information or HSN-wise inward supply information. If the data is available, it is better to give. If you honestly ask me, if the organization has that kind of data with them and they have the habit of collecting the data and making it presentable in a particular way, it is better. It is getting reported correctly. Once it is all done, it would be ready for a preview and we can take it up. After this preview, we can proceed with filing of it. So that is some of the points in connection with GSTR 9. Quickly, let me get into the GSTR 9C related discussions, where it is going to be a reconciliation statement. When we come back to a discussion in connection with GSTR 9C, as usual, 5-part discussion as far as GSTR 9C is concerned, a 5-part discussion. And as far as this 5-part discussion is concerned, basic information, a reconciliation with the financial statement, a reconciliation of taxes paid, reconciliation of ITC. Earlier used to be called as auditor's recommendation. Now also it is called like that. It requires a little amendment, but of course, end of the day, they remove it and call it as a self-certification. Getting into the reconciliation statement straight away, the state turnover would be the starting number. Having arrived the state turnover as the starting number, and no doubt the reconcilable number, the last number would be the total turnover. Just now we saw total turnover 5N plus 10 minus 11. It's total turnover. That number will get auto feeded here. When this is going to be the auto feeded number and the total turnover, will there be gaps? Definitely there will be gaps. There would be possibility of a deemed supply. A deemed supply, in case if it is passed through the profit and loss account of the respective state, in case if it is passed through the P&L account or trial balance of the respective state, then the deemed supply would be part of the reconciliation and it should be added back. Similarly, credit notes that are given without disturbing the GST. Do we still have this concept of financial credit note? Yes, we still have this concept of financial credit note. That is why we used to call it as GST credit note and financial credit note. GST credit note means reported. In GST portal, in GSTR1, it is reported. Financial credit note. Take 5 lakhs credit. I mean, you have been with me, so take 5 lakhs. Financial credit note. You have to pay me 95 lakhs. Don't pay me 5 lakhs, pay 90 lakhs. Matter ends there. Whatever ITC I have given to, I have paid to government, whatever taxes I have paid to government, you are entitled to claim credit. You will also not disturb the ITC. I will also not disturb my ITC. So that is a mutual agreement that they do. Now, in a background like this, in case of a credit note that is given at the end of the financial year may be a possibility, or unadjusted advances at the end of the financial. Maybe this year and all, last year, what was the unadjusted advances that would be brought in? And similarly, unadjusted advances, unbilled revenue at the end of the year, at the beginning of the year. Certain service-based organization alone, this will come because they work on this model. So there would be a possibility opening unadjusted advances, closing unadjusted advances. So net effect, we will have it in the 4F. Opening unadjusted advances plus advances received during the year, less adjusted advances, closing we will have. In other words, the effect, net effect of this would happen in the 4F. Advances received during the year after adjustments. If it is adjusted, balance, net advances, that will be reported there. So coming back here, those informations would be of little important. If we have a client with all this, then we have to take care it in a little more detailed way. If you have a client who's dealing with SEZ information, then the supplies made by them from the SEZ to DTA, that will be completely out from the limits. In other words, completely out from the limits means supply of goods by SEZ to DTA, it will be treated at par with customs. So when we look their turnover, it will be 5 crores. And when we look at their GST return, it will be only maybe 35-40 lakhs, or vice versa. Let me put it in this way: 5 crores turnover, 4.5 crores only reported as exports. What is the gap? Nothing but they have sold the goods to the domestic market. Movement of goods by an SEZ to DTA is treated at par with import. So it's customs formality that would be followed. It would not form part of this discussion. So it should be removed. So those exceptional adjustments, whatever I have highlighted, should be done. Apart from this, any adjustments done on account of valuation, any adjustments done, it could be on account of related party valuation, it could be on account of supply of goods or services at free of cost related adjustments, any valuation based adjustments, including one of the valuation based adjustments such as forex fluctuation, all this will be reported. Certain special transactions like profit on sale of assets, sale of building, sale of investments such as shares, debentures, mutual funds, all this. Reporting of this is becoming important because in the P&L, very simply, profit on sale of shares came. When it comes to the reconciliation, the said profit on sale of shares should be excluded as part of the other reasons which is not listed above. If it is profit on sale of building, if it is there, then sale of building per se, sale of building is a non-GST supply. So base value, should I need to report it in the main 9 return, and I would exclude it here. It's all individual call. From case to case, we have to decide. How one of the easiest way often it is done is As part of other adjustments, it gets reduced. What is the profit element of it? Only the profit element. Profit on sale of building excluded. Profit on sale of land excluded. Profit on sale of excluded. Of course, for the purpose of Rule 42 calculation, it is an independent calculation. It might be considered, but at a reconciliation of revenue level, it is considered separately. Where we would be having certain challenges is in case if it is going to be some of the principles or revenues that are recognized based on certain revenue recognition principle. Maybe organization will be involved in exports. So MEIS license receivable will be recognized. Actually received and sold will be a different number. So we should reduce this number. What is actually sold is reported in exempted supply. We should arrive at via media number. And this adjustments has to be done. It cannot be shown as a difference. Let me repeat. So these are all the key aspects in reconciliation. Let me repeat even it for the cause of repetition. To the extent possible, if table 5, table 7, table 9, table 5, table 7, if it is going to have no differences or no unreconciled turnover, it will be of great help to the organization. No second thoughts, including table 12 and 14 of same 9C. If there are differences, no doubt, there are going to be challenges that are associated over here. It's only the transaction decides. Is it export turnover, or it is sale of land, sale of building, sale of asset? Sale of asset also. Maybe you would have sold the asset for a full value, let's say 10 lakhs. Then in GSTR, we would have reported the 10 lakhs. But when it comes to profit and loss account, we will not report the sale value as 10 lakhs. We will report only profit on sale of asset, which will be only 3 lakhs. Now this creates a disparity between 10 lakhs and 3 lakhs, 10 lakhs in GSTR 9. Now what should I do here? Now I should reduce the profit on sale of asset under any other adjustments and add the turnover of sale of asset 10 lakhs. Now this would arrive into my reconciliation. It's explainable. So every single transaction has to be looked into and then it has to be done to ensure it is reported. If in case the turnover is not properly reported for some reason, in 9 they have already filed and they have the habit of filing 9 by themselves, they still have differences. Differences could be, to my mind, only 2 broader classification. One could be a taxable turnover, another could be an exempted turnover. If it is an exempted turnover, then it would be reconciled in the next table. Maybe after the outcome of the next table, we can give reasons over here, because table number 5 was reconciliation of turnover as per books and GST. Table number 7 is reconciliation of taxable turnover. Here we will try to reconcile with table number 4. If we highlight it here, we will reconcile with table number 4. 4N minus 4G, which means we are reducing the inward supplies on which tax payable under reverse charge, which is nothing but RCM turnover is reduced. Taxable turnover we are reconciling. So what are all the exempted turnover which of table 5 when we will reduce? So even if exempted turnover not reported, it's okay. But if a taxable turnover itself is not reported, then it would result to, yes, a taxable turnover not reported. Then it would result in tax pay, and which would lead to a reporting of rate-wise, respective rate-wise reporting, 5, 12, 18, 28, 0.1, 0.25, 3%. In every respective models, it is payable. So in case of this point one and all, they would have supplied goods to a person who has exported goods. If it is respective rates, we can do a cross verification here, whether they have charged the respective correct rate of tax in case of certain products. A random sample can be taken, and based on that we can do it, whether they are correctly classified their goods as 12% as 12% or 5%, 18% as 18%. That respective rate classification we can always. Moving from rate-wise comparisons, a rate-wise comparison, CGST, SGST, IGST, the respective tax are getting compared. From the table number 9, table number 10 and 11, the tax are summed up and that are getting compared over here. Usually we will have difference in table number 9 because we are not considering late fee. We are not considering interest in case even if it is paid also. Recollect, there it was I would put it in this way, row-wise reporting. There it was a row-wise reporting of CGST so much, SGST so much, IGST so much. Sorry, CGST, SGST, IGST, tax, interest, penalty, late fee so much. Here also we are reporting tax, interest, penalty, everything. But the table is so well structured that it is linked only to the taxes. For interest, late fee and penalty, the table was not linked. Because of that reason, often you will get in 9 a difference. That difference will be late fee, interest and penalty or tax not paid. Definitely. Tax not paid. If tax is paid, will we still have interest difference? Yes. That would be interest, late fee and penalty. So that is a design challenge that we are facing due to interest, late fee and penalty, which is either paid in 3B or through DRC 03 or still payable. We will have a differences and that differences has to be considered. At times, if in case there are a difference of opinion, even that time you will have this, but currently now we will not be having those differences. A consolidated number for the output tax liability of 6, 8 and 10, we will have any additional tax payable will be brought into here. Table 12 of ITC. The total ITC will be brought in as a single number. That is CGST plus SGST plus IGST will be consolidated and brought in as a single number here. ITC availed. Technically as per the books of accounts. So respect to books of account, what is your total ITC availed during the year? And of this ITC availed, it is an entry made in the books in the last financial year and claimed in current financial year. ITC booked in earlier financial year and claimed in current financial year should be added. ITC booked in current financial year and claimed in subsequent financial year has to be reduced. Total ITC taken this year, taken in 3B, not taken in the books. Let me repeat. That's also there's another confusion. The total ITC taken in the books as per 3B, that ITC, add ITC of last year claimed in this year, ITC of this year, whatever it is there, that claimed in subsequent financial year or eligible to be claimed, but claimed in subsequent financial year. We will arrive a number. That number should match with the ITC that is there in this table 7J of 9. Definitely we will have differences on account of reversals if they have any, if any they have. Otherwise it would match. If they have filled something in table 7, they have reversed the ITC on account of 42, 43. They reverse the ITC on account of wrong claim 17.5. In case they have taken and then reversed. 17.5, if they have taken only, then they will reverse. If they are not taken, where is the question of reversal? Taken, reverse, some differences if exist, I mean, if they reverse something, then definitely that would result in reversal. And that reversal has to be explained in the table, whether it is reversal on account of done during that financial year or during done subsequent financial year. If it is done that financial year, nothing great, we can refer it. It's done in subsequent financial year, then any case table 12 of subsequent GST 9 will help us. Or it is done even through DRC03 separately, then those references. Reason for a difference. I'm just extrapolating a reason for a difference. I'm not saying this is alone possible, but if somebody of this table, of course, very interesting part is I do agree. Table number 12 and table number 14 are optional table. It is not a mandatory table. So if someone can also skip a table in connection with enough data is not available or the way in which they categorize, I don't have a data possible. Organizations can always come out and say. Table 14, expenses wise breakup of ITC taken. The earlier table, they have just consolidated what is the total ITC taken. Now, for that ITC that is taken, they would like to know how much is on account of purchases, how much is on account of freight, how much is all the other expenses wise data are taken. In this expenses wise detail, whatever expenses wise detail, which has been given as a breakup, amount of ITC and amount of eligible ITC that would be there, and that would be reconciled with the already existing table in GSTR 9. Here also you will have a difference generally, because if there is any ITC reversed, to the extent of reversal done, we will have a difference. Reversal done during the financial year, reversal done in the subsequent financial year, and all those reversal done through DRC03. Definitely those reversals, because we are comparing a gross number with a net number. Let me put it very simply. I'm sure all of us would appreciate. Be it table number 12, be it table number 14. It is very, very tough for somebody to arrive at table number 12 with net numbers. At least many instances that I have come across, we have come across only instances where it is easy for organizations to give gross numbers. My gross ITC is so much. When we compare the gross ITC with the net ITC, naturally there will be differences. That differences would be here. No. If the organization could be able to give a net ITC, then there will not be differences, no doubt. But getting that net ITC is little laborious activity, which is there. That is why, in fact, that is one of the reasons why this table itself is skipped. I can very comfortably say I have taken credit on 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 expenses. Maybe in purchases, one of the purchases would be relating to exempted supply. So I would have reversed the credit. Now, give me the information of only net ITC on purchases. It's very difficult for me as an organization. So I can give you gross. And I can say I have reversed so much ITC, and reversals you verify it separately. I match the gross. There is a gross with a net number. When I compare, there is a difference. That difference results in reason for subsequent reversals only. I have reversed this ITC on account of X reason, Y reason, or I have reversed it during the year, subsequent year. And we go to table number 7, we will get the reason why ITC is reversed. Many times this will not be applicable, but in case if an organization uses it, then yes, they will be in a position to take it up. If any ITC is payable on account of this reason, then it will be reported in the table number 16 separately. So those are all the aspects in which a reconciliation point has to be taken. I think within the given time in my hand, I have tried to elaborate the points in connection with GSTR 9 and 9C. I do understand there will be few questions. I'm not very sure I would have touched up all the points that you came sit into this virtual session. Any questions? Yes, that are there. I would be happily taking it up. I have few questions on the chat box. How should I go about it, Deepa ma'am?
So you can either read it yourself or I can read it for you. I find only one question on the Q&A tab.
In the chat box, one
On the
question.
Q&A box.
Okay, Q&A.
Chat box also, I think Ramakuti sir has posted one question, so we can take that also up.
Yes, sir. Raman Kuti sir has raised a question. If
Yes,
previous
on the chat.
credit, if previous credit available is excluded from 6B, 6J will not be negative. Same in the case with 8D. Okay. Whether previous credit availed is excluded from 6B. I will completely agree with you, Raman, sir, but the challenge here is the word used in table number 6 is ITC availed during the year. Already we are into dispute what is ITC availed. I understand it as ITC taken in the financial year. If ITC is taken in this financial year, then only to that extent ITC has to be applicable. So let's for an understanding discuss in this way. 1 lakh ITC is relating to that year has taken. I mean, in that year 1 lakh ITC is taken. 10,000 is relating to previous financial year. And total ITC of 1 lakh is taken. Naturally, my GSTR 3B will get auto-populated for 1 lakh. My table 6A will get auto-populated for 1 lakh. If I mention in 6B only 90,000, saying the fact that this year ITC is only 90,000, in table 6 itself, I will have a difference between my ITC taken and ITC available, mean ITC of this year. So I am of a view that when it comes to reporting, we should go by the month in which credit is taken as a reporting model in table 6. So where my 6A will also say 1 lakh, my B2B inward supply will also say 1 lakh. I would not have differences in table 6. Do agree with you. When I go to table 8A, it will say only auto-populated number is 90,000. But whereas my difference, whereas my ITC taken will be 1 lakh, I can happily convince my officer saying that, look, my last year annual return, I had a short claim, and that short claim is claimed now. This has to be reconciled. I do agree. When my number is 1 lakh and 10,000, we can happily do all these adjustments and share. When the numbers are going to run into few crores, identifying and pinning down to this level is going to be really challenging. But my only recommendation is this annual return format has to undergo a change, no doubt about it. At that time, we can give recommendations in table 6 itself. This is the ITC relating to this financial year, and so much of ITC is relating to previous financial year. If we break it at that level itself, then I understand that would be helpful both for table 6 as well as table 8 related comparison, and give us a better, more understanding. So however, that can be only for the future. Current model, I am of a view it has to be reported like this. Getting into yet another question.
When they tab also, there is one question, sir, next to the chat box.
Table 10 is subsequently, table 10 is subsequent year amended in 1 or reported in 3B? Nice question from Ganesh Krishna. Now, often this debate is going on. Is it 1 an important return or 3B an important return? Generally, GSTR1 and GSTR3B both has to go hand in hand, or it should go, I would say, I put it in this way, it should go as hand and glove. If GSTR1 says something else and 3B says something else, possibilities are there. Let me repeat, honestly, yesterday evening also we had a possibility. Nothing. GSTR1 is filed for 22 crores. Turnover of the assessee is 12 crore for the month. That's nothing. In B2C, some 10 crores is added. At the last, he added 2 zeros extra. Beyond that, nothing. Just 2 0. At a data entry level, in spite of validation, maker checker, 5 level of hierarchy, did the fellow who pulled the data, the fellow who filed the data, who fellow upload the data, fellow who pays the sets the digital signature, all are being different person. They missed 2 zeros only. Now, in these circumstances, what is my final number? Is GSTR1 or GSTR3? I come from a very specified school of thought. GSTR3B is important because GSTR3B is the one that discharges the tax liability, and GSTR1 can be amended if it is identified within like this. We are very clear when it is, though it is belatedly filed, we are very clear that by next month, 4th or 5th, we are going to go and do the amendment. Once it is amended, it will be set right. But the point here is this fact will get highlighted maybe earlier as part of GSTR report, GSTR annual return report. A note will be by the auditor. Today, a self-note need to be prepared. Observation report has to form part of it. The management has to put forth certain observation. On review, we saw 1 and 3B was different. I would recommend you should go only by 3B, which should be generally correct. No, in my case, 3B is wrong and 1 is correct. Then we have to only emphasize that fact. But it is only 3B who will gain its more advantage and weightage. Do agree at times the turnover related matter 3B might go wrong. Maybe in the exempted turnover in GSTR1 they made it correctly, 1 crore 36 lakhs they reported it correctly. But while reporting in GSTR3B, erroneously they made a data entry as 3 crore 60 lakhs. If it is a turnover number, don't be bothered about 3B. Take GSTR1 into confidence. If it is tax number, then take 3B into confidence, not GSTR1. So this divided approach we have to have to arrive into certain solutions in connection with this particular issues like this. These are all not regular issues. These are all exceptional issues. Some sort of note has to be prepared and uploaded. Let me repeat, there is a facility to upload. Tomorrow, with due respect, my officer will come out and say that as if he has unearthed, dig the, dig the graveyard and identified or obtained the skeleton out of it. Otherwise, you would have missed the eyes of the tax revenue and all. You'll say nothing of that sort. I myself has reported it. See, my auditor has reported. Earlier, we used to say my auditor has reported. We are facing issues like this. Why not the 67 lakh rupees reversed in 3B can be appropriated? I asked on the other day respective assistant commissioner on the hearing, who are you to appropriate? I have already appropriated and filed my annual return. Why you are negating my annual return and not taking up? See, this is a stereotyped return model, all that, whatever we can call it as. But those facts, when it is being written and submitted as an internal observation of the organization today, as an observation note signed by the respective authorized signatory, if it is yet another attachment, I identified in 1 and 3B. I understand there is a mistake in 3B. There were 0 exempted number is reported correctly, or tax. There were situations we have come across like this. Tax will be correctly paid, but turnover one number will be wrong in 3B, not in 1. At that time, you should go by 1. Vice versa is there, but it is little different. So those aspects has to be taken care correctly, in my view. Beyond that, we don't find any challenges associated with it. 1 or 3B, if it is turnover number, go by 1, if it is right. If it is tax number, go by 3B. That is about the specific question. In chat box, Roshini Menon has raised a question.
So unless something's come to you directly, nothing has come to all of us. So.
Oh, okay. I'll do one thing. I'll repost the case. Sorry.
No, you may read it and continue, sir.
Okay. Cases have been noticed where the ITC as per table 8 from GSTR 2A is not matching to the invoice-wise detail given in 9. And the difference is not identifiable at times. Any solution? Cases have been noticed where ITC as per table 8 from GSTR 2A is not matching with invoice-wise detail given in GSTR 9 in Excel. I am of a view in GSTR 9 invoice-wise details we will not give. At 2A and 3B will be getting reconciled only at a number level. If I understand the question, I'll put it this question in a little different way. Maybe the questioner only has to think about it. That is the intention. ITC as per transaction level, as per what I claimed, and ITC what is appearing in 2A. When I compare it on transaction to transaction level, it is not matching, it is different. Let me repeat, it is as simple as that. There are 10 transactions. Of the 10 transactions, the assessee has taken ITC on 8 transactions. So all 10 transactions, not all 10 transactions got reported. Only 8 transactions got reported. But very interesting to note, the assessee has taken transaction ITC on 8 transactions. Of that, 1 transaction is not reported. Instead, the ITC of assessee has omitted 1 transaction. That got reported. Let me repeat. At an individual level, that differences will exist. What I was highlighting here is, what is your actual credit, as per GSTR 3B, respective ITC, followed by, you would be mentioning in table 6B of GSTR 9 your eligible credit only, for which the backed up by documentation, compliance of section 16(2), all are done and ITC is taken. Given an environment like this, one of the requirement would be whether these transactions are matched in 2A. Should be definitely the management's responsibility. No doubt about it. But only thing is, I have 15 inward supplies. Only 10 inward supplies I have taken credit. So naturally, table 8 is little favorable to me. Can I go about it? It looks good. What looks good is always not good. So maybe that would be my simple way of sharing it. Individual analysis has to be done. That is up to the management to take a call in connection with it. Maybe on the 10 transactions, 1 or 2 transactions would have not appeared, but it would not be known on face of 9. Let me repeat, it's not a problem at the face. Maybe at a little later level, it can be identified. Those are the questions I had in the chat box.
Yes, sir. Members, in case any one of you have any further queries, please write to us at the Q&A box right now. Meanwhile, I take this opportunity to thank CA Ganesh Prabhu for that simple yet detailed presentation. Sir, I don't think anything could have been more simplified than this on GST. You were so patient when very slowly explaining each and every point. So thank you so much for that. As you are aware, the present managing committee is laying down or preparing to lay down its office in the coming month, and the new managing committee is all ready to take over. So we hope that we continue to get your support the way you have been supporting the earlier committee. Thank you so much, sir. We will see you for more programs in the coming days.
Thank you. Thank you. Thank you.
And thank you, dear members, for joining us. Just like I thanked Ganesh sir for his support, may I request each one of our members to continue your support to the new managing committee, which is all set to take charge in the coming month. And a very big thanks on behalf of each and every managing committee member of the previous managing committee, right from our chairman, C.A. Ranjit Warrior, vice chairman, K.V. Jose, treasurer, Alan Joseph, SICASA chairman, C.S. Salim, a past chairman, C.S. Srinivasan PR, and C.A. Roy Burgess. Thank you so much to each one of you for the support that you have extended to us, and we hope that you will continue to do so. A very big thanks to our staff at the branch for the support that you have been extending to us. I once again take this opportunity to thank each and every one of you on this program. We'll see you soon again from Ernakulam branch. Thank you.
I thank you all for an effective patience. Thank you.
Thank you.
Thank you, Ganesh sir. Thank you very much.
Thank you.